Welcome to the deep dive.
Today we're tackling something, well, really fundamental for anyone trying to navigate the stock market, especially here in India. The NSE, the BSE, we're talking about the stock market cycle.
Exactly. Think of it like the market's heartbeat, its rhythm,
hmm
understanding these cycles. It's not about having a crystal ball, right?
Right, no guarantees.
But it is about spotting patterns,
Yeah.
recognizing how the market tends to behave again and again.
hmm
And that recognition, that can genuinely help you make, let's say, more informed decisions.
Okay, let's dig into that. We're using a really interesting framework today, Wyckoff's theory, and focusing on three sort of key phases: accumulation, participation, and distribution.
Yeah, you can think of them almost like market seasons. Each one has its own feel, its own
Depends
character.
on players, too, right?
Right.
Especially in the Indian context.
Absolutely vital to consider who's active. You've got the big institutions, the FIIs, foreign institutional investors, DIIs, domestic ones, the HNIs.
High net worth individuals, right. And then, of course, the huge number of retail traders now. Everyone using platforms like Zerodha, Upstocks, Grow, Angel One, they're a major force.
So the mission for this deep dive is pretty clear. We want to give you a solid understanding of these phases and maybe more importantly, how you might actually, start to identify them playing out in the Indian market.
Exactly, to empower you, basically, give you that extra layer of understanding.
Okay, let's jump right in. Phase one, accumulation. What exactly is that?
Accumulation.
Mm.
At its core, it's when let's call it the smart money, those big institutional players we mentioned, they start quietly buying stocks after the market's taken a hit.
After a downturn.
Yeah, they're essentially bargain hunting, picking up shares they think are good value, but doing it very carefully.
Quietly seems like the key word there. They don't want to make waves.
Precisely. They want to build their positions without attracting a lot of attention, without driving prices up against themselves. So picture this. The market's had a correction.
Maybe after the budget or some global scare.
Could be anything like that. The heavy selling starts to ease off. That's the window. The smart money sees value. They start buying, strategically absorbing the shares people are still selling.
But gently, so the price doesn't shoot up.
Right. And often this leads to the price moving sideways, forming what we call a trading range. It bounces between a floor, a support level, and a ceiling, a resistance level.
Okay, so if I'm looking at my charts, maybe on Zerodha or TradingView, how do I actually spot this? What are the clues for accumulation?
Okay, several things to watch for. First, the price action itself. You'll often see that sideways drift, that range-bound movement we just talked about.
Uh-huh.
Volatility tends to be low. There isn't strong conviction either way yet. You might also see the lows getting slightly higher each time the price dips, or just a really solid floor, that support level holding strong.
Like, say, Tata Motors just stuck between maybe 800 and 850 rupees for weeks on end.
Exactly like that.
Yeah.
That kind of stable, sideways churn, that could be accumulation. Meanwhile, retail might still be hesitant, right? Anchored to those old higher prices.
Okay, sideways, low vol, maybe higher lows or strong support. What else?
Volume. Volume is super important here. Usually during accumulation, trading volume is low, maybe even declining.
Because people are discouraged after the fall.
Yeah, many participants just step back. But, and this is key, watch out for sudden, brief spikes in volume that don't seem to have a clear news reason.
Ah, the footprints of the big players.
Could be. It suggests institutions might be actively buying, stepping in when prices dip within that range.
Interesting. Sneaky. What about chart patterns? Any shapes we should look for?
Definitely. Certain patterns pop up often. The most obvious is the rectangle, that sideways box we discussed.
Right.
You might also see a double bottom. Price tries to fall below a certain level, gets bought up, tries again, gets bought up again, shows sellers are losing steam.
Okay.
And then there's the spring. This one's quite clever. Imagine the price briefly dipping below that established support level.
Like a fake out.
Exactly. Shakes out nervous holders. Then bang, it quickly recovers and jumps back into the range. Like our Tata Motors example, maybe a quick dip below 800, then right back up. That's a classic sign accumulation might be happening.
Okay, so price, volume, patterns like rectangles, double bottoms, springs, any technical indicators that help confirm.
Yeah, indicators can add confirmation. Low volatility often shows up as tight Bollinger Bands, the bands on the chart squeezed together.
Mhm.
Momentum indicators like the RSI, Relative Strength Index, often just chop around in the middle ground, say between 40 and 60. No strong buy or sell signal there. The MACD might look pretty flat too.
And the general feeling, the market mood, the sentiment,
Generally, during accumulation, the news flow is, well, not great. It might be bearish or just neutral. You might see reports about weak company earnings or maybe headlines about FIIs still selling.
Stuff that keeps retail investors nervous.
Exactly. And if you look at social media, X, WhatsApp groups, you'll often see pessimism, frustration, maybe just apathy from retail traders, markets going nowhere, that kind of thing.
Makes sense. The smart money wants to buy when things look bleak. Can you give us a real-world Indian example just to cement this? You mentioned Reliance earlier.
Sure. Think about a time, maybe after a market dip, when Reliance Industries seemed stuck. Trading, let's say, between 2,500 and 2,600 for a few months, volume was probably pretty low overall, and the news might have been full of global worries, maybe oil price concerns, whatever. That whole picture, sideways price, low volume, negative-ish news that could easily have been an accumulation phase in Reliance. Smart money, quietly building lines.
Got it. That paints a really clear picture. Okay, so after accumulation, things eventually start to move. Let's talk about the next phase. Participation or markup. Sounds more exciting.
It definitely is. This is where the market or the stock starts to visibly trend upwards.
So the quiet buying stops and things break loose.
Pretty much. The smart money, having built their positions, stops aggressively absorbing all the shares offered for sale. This lets the price finally push through that resistance level, that ceiling of the accumulation range. The breakout. Now, some early buyers might take a little profit here, sure, but typically new buyers jump in, retail traders notice the move, domestic mutual funds start allocating capital, smaller firms join in. They see the upward potential now.
And what usually fuels this? Is it just the technical breakout?
Often there are positive triggers. Maybe strong GDP numbers come out, maybe the RBI cuts interest rates, making borrowing cheaper, or key companies report fantastic earnings.
Right, real fundamental drivers.
Exactly. These act like fuel on the fire. And then you absolutely have to factor in FOMO.
Fear of missing out.
Yes. Retail traders see the price climbing on their apps, the news turns positive, their friends are talking about making money. That fear of missing the ride kicks in hard.
Powerful force indeed. So what are the signs that tell us, okay, we're probably in the participation phase now?
Okay, price action is the most obvious. You see that clean break above the old resistance? In our Reliance example, a solid move above 2,600 that holds.
Doesn't just poke above and fall back.
Right. And crucially, the stock starts making higher highs and higher lows. That's the classic definition of an uptrend. Each peak is higher than the last. Each dip finds support at a higher level than the last.
Higher highs, higher lows. Got it. What happens to volume? Does it pick up?
Typically, yes. Volume usually increases noticeably. More people are getting involved, right? So trading activity rises. You'll often see big volume surges on the breakout day itself, or even on days when the price pulls back slightly before resuming the climb. That high volume on pullbacks confirms buying interest.
Okay, rising volume confirms the trend. Any particular chart patterns for this phase?
Yeah, bullish patterns emerge. You see those clean breakouts above resistance we mentioned. You might also see patterns like ascending triangles where the price makes higher lows against a flat resistance before breaking out upwards. Or a cup and handle pattern. Looks like a teacup on the chart. A rounded bottom, the cup, followed by a smaller consolidation, the handle, then a breakout upwards. You see these quite often in big names like HDFC Bank or Infosys during strong market runs.
And the technical indicators. They must start looking pretty bullish too.
Oh, absolutely. Momentum indicators like the RSI will typically climb above 60, maybe even push towards 70, showing strong buying pressure.
Okay.
The MACD indicator often gives a bullish crossover. The MACD line crosses above its signal line. That's another sign of building upward momentum. And the Bollinger Bands. They usually start widening out as volatility picks up with the stronger trend.
And the overall mood. The sentiment shifts dramatically, I assume.
Completely. Sentiment turns clearly bullish, optimistic. Financial news starts focusing on the positives reports of FIIs pouring money back into India, analysts upgrading stocks left and right.
Everyone's feeling good about the market.
Pretty much. On X, on Telegram groups, retail traders are buzzing, discussing how high things could go, sharing bullish charts. The narrative flips from caution to opportunity.
Can you give us a quick real-world Indian picture of participation? Can we stick with Reliance?
Sure. Imagine Reliance breaks strongly above 2,600 after reporting great results. Volume spikes. Then, over the next, say, 2 months, it rallies up to 3,000. During that climb, you see reports of mutual funds increasing their holdings, retail participation numbers going up. And the Nifty 50 index is probably also making new highs, partly driven by Reliance's strength. That whole scenario is classic participation.
Okay, that makes the transition really clear, from quiet accumulation to that energetic participation. Which brings us to the third phase, distribution. This sounds less fun. Is this where the party starts to wind down?
It is often where the trend begins to falter, yes. Distribution is essentially the mirror image of accumulation, but happening at high prices. It's where the smart money, who bought low and rode the trend up, starts to sell their holdings.
Selling to who?
Selling to the people who are often arriving late to the party, primarily retail traders, often caught up in the excitement and optimism generated during the participation phase. It's a transfer of shares from informed hands to perhaps less informed hands at potentially peak prices.
So the big players cash out, while everyone else is still feeling bullish. How does that actually happen in the market?
Well, after a good run-up, those institutions and HNIs start thinking, okay, things are looking a bit stretched now. Maybe valuations seem too high compared to earnings, or future growth looks less certain.
Right.
Their goal is to sell their large positions, but again, without causing a panic or crashing the price immediately. So they sell gradually, strategically. They feed shares into the market as long as there are eager buyers.
And the buyers are there because of the recent rally and good news.
Exactly. Retail traders, driven by maybe greed now or still that FOMO, keep buying, thinking the trend will just continue forever. This buying absorbs the smart money's selling, and it often causes the price to, again, move sideways in a range, but this time at a high level.
So it looks like consolidation again, like accumulation, but the underlying dynamic is totally different. Selling instead of buying.
Precisely. The appearance can be similar a trading range, but the intent is the opposite.
Okay, so how do we differentiate? What are the clues that this sideways move at the top might be distribution, not just a pause before another leg up?
Key things to watch for. Price action. Yes, it's sideways after a rally, like our Reliance example may be churning between Honor 900 and 3,100 after hitting that peak. But within that range, you might start seeing lower highs. Each little rally attempt stalls at a slightly lower point, or just a very firm ceiling that resistance level holds strong, price just can't break through.
Wait, lower highs or stubborn resistance. What about volume during distribution?
Volume here can be tricky. It might still be quite high initially because there's a lot of churning, buying, and selling, but a key sign is often declining volume over time within that range. Even as the price stays high, it suggests the buying power is fading.
Less enthusiasm.
Could be. And critically, watch for days with heavy selling volume, especially if the price closes weak on those days. Big down days on high volume are often footprints of institutions unloading shares.
Got it. Heavy volume on down days is a red flag. Any specific chart patterns associated with distribution?
Yes. Classic bearish reversal patterns tend to form here. The famous head and shoulders pattern is one. You get a peak left shoulder, then a higher peak, the head, then a lower peak right shoulder, all sitting above a common support level called the neckline. Breaking that neckline is usually a sell signal.
Okay.
You might also see a double top. Price hits a high, pulls back, rallies again to roughly the same high, but fails to break through and falls back again. Two failed attempts suggest buyers can't push it higher. And then there's the shakeout, but working in reverse. It's like a bull trap. The price might briefly poke above the resistance of the distribution range.
Sucking in more buyers who think it's breaking out again.
Exactly. They jump in thinking, here we go again, and then boom, the price reverses sharply and drops back down, often starting the real decline. The smart money used that brief surge of buying to sell even more. Imagine Reliance popping just above 3 out the 100, getting everyone excited, then falling hard.
Ouch. Those shakeouts sound dangerous. What about the technical indicators during distribution?
You often see bearish divergences. This is important. For example, the RSI might be making lower highs, while the stock price itself is still making slightly higher highs or moving sideways.
So the momentum is fading even if the price isn't falling yet.
Correct. It's a warning sign that the underlying strength is weakening. The RSI might also push into overbought territory, above 70, and then fail to stay there, or just struggle to make new highs along with the price. It signals buying exhaustion.
And the sentiment. If accumulation was pessimistic and participation was optimistic, what's distribution like?
Distribution is often marked by euphoria. Extreme optimism, sometimes bordering on complacency, especially among retail investors. They've seen great returns. The news is still mostly positive.
So they think the good times will never end.
Pretty much. You might see wild predictions on X or YouTube. This stock is going to double. Maybe about popular names like Adani stocks or Tata Motors again. The media might also be hyping things up, focusing on the gains, maybe downplaying risks, all while the smart money is quietly heading for the exits. It's peak optimism, often just before the turn.
A dangerous time to be getting swept up in the hype.
Yeah.
Can you give us that Reliance example again, but for distribution?
Sure. So after that rally to, say, 3,000 there, imagine Reliance starts trading sideways, maybe between 2,900 and 300, 100 for a couple of months. The sharp upward momentum is gone. Volume might still be decent, but maybe it's slowly trending lower overall. You see some days with heavy selling, but the price holds the range for a while. But if you check social media, retail sentiment is through the roof. Reliance to 3,500 next. Everyone's bullish. That whole picture, stalling price at highs, potentially weakening volume, but extreme retail optimism that could be a distribution phase in action.
Wow. Okay. Accumulation, participation, distribution. It's a really powerful framework. Now let's bring it back to our listeners, especially those maybe newer to the Indian market. What are some practical tips, some key takeaways to help them actually use this understanding?
Okay, first, and maybe most important, combine the signals. Don't just look at price or just volume or just one indicator. Look for confluence. Does the price action match the volume? Do the indicators confirm the pattern? Does the sentiment fit the picture?
So build a case. Don't rely on one clue.
Exactly. And also, look at the big picture. Check the chart of the Nifty 50 or the Bank Nifty. Is the overall market in a similar phase? An individual stock is more likely to follow the broader market trend.
Good point. Context matters. What else?
Understand the typical sequence. Accumulation usually follows a correction. Distribution usually follows a strong rally. Knowing where you might be in the bigger cycle helps interpret the current signs. Think about recent events. Did we just have a big sell-off, suggesting potential accumulation next, or a huge run-up, suggesting potential distribution?
Like checking the market weather before looking at one specific plant.
Kind of, yeah. And keep a very close eye on volume. We've stressed this, but it's crucial. Low in accumulation, usually. Rising in participation, maybe high but erratic or declining in distribution. Use tools like Money Control or your broker's platform to track it easily.
Right. What about timing? Do these phases happen quickly?
Rarely. That's why patience is key. These phases can last weeks, months, sometimes even longer, especially in a market like India's, which can be influenced by things like FII flows, RBI policy shifts, election cycles. Don't rush to judgment. Wait for the evidence to build.
Patience, patience. Okay. And for someone starting out wanting to practice spotting these phases?
Best way. Study historical charts. Seriously. Pull up TradingView or Zeroda's Kite or whatever platform you use. Go back in time on charts of stocks like SBI, ITC, HDFC Bank, even the Nifty Index itself. Try to mark out periods where you think accumulation, participation, and distribution were happening based on the clues we've discussed.
Like backtesting the concept visually.
Exactly. The more charts you look at, the more you train your eye to recognize these patterns and characteristics. It's invaluable practice, and it costs nothing but time.
Great advice. Let's make it even more concrete. Can you walk us through a simplified, hypothetical cycle for a specific Indian stock, maybe Infosys?
Okay, let's imagine Infosys. Say it falls from a high of 2,000 down to 1,400. Maybe there's some bad news for the IT sector globally. That's the initial downtrend.
Okay, pre-accumulation.
Right. Then for the next, say, 3 months, Infosys just chalks sideways, mostly between 1,400 and a 1,500. Volume is pretty low. News headlines are still maybe a bit negative about IT spending. FII is selling IT stocks. But behind the scenes, maybe some long-term value investors, the smart money, are starting to buy quietly. That sideways churn, low volume, negative sentiment, that's our accumulation phase.
Got it. Stuck in that 1,400, 1,500 box, what happens next?
Then, boom, Infosys reports fantastic quarterly results, much better than expected. The stock gaps up, breaks decisively above 1,500 on huge volumes.
The breakout.
The breakout. And over the next couple of months, it rallies strongly, maybe up to any 100. Volume stays high on up days. Retail interest picks up. Analysts upgrade the stock. News turns positive. That's participation. Clear uptrend, rising volume, bullish sentiment.
Okay, riding the wave up to 1,800. Then what?
Around 1,800, maybe it starts to slow down. It trades sideways again, perhaps between 1,750 and 1,850. The sharp climb is over.
Consolidation at the top.
Right. Now, retail traders on X might still be super bullish Infosys to 2,000 soon, but maybe the overall volume starts to gradually dry up, or you see some big down days within that range. This could be distribution starting. Smart money is selling to the optimists.
Okay, and the end of that phase.
If Infosys then breaks below the support of that range, say below 1,750, that could signal the distribution is complete and a new downtrend is beginning. Panic might set in among those who bought late, leading to more selling. The cycle begins again.
That's a really clear illustration, thank you.
Okay.
Okay, let's zoom out from a single stock. You've looked at the big picture, the Nifty 50 index, going back quite a few years, from 2017 up to now, May 2025. What does applying this cycle framework tell us about the Indian market as a whole over that period?
Looking at the Nifty over that time frame is fascinating. You really see these cycles play out on a macro level. For instance, 2017 into early 2018, classic participation, strong FII inflows, optimism around GST implementation, lots of retail joining in. Nifty rallied from around 9,500 to nearly 11,800.
Okay.
Then, late 2018 into 2019, things got choppy, global trade tensions, some domestic liquidity issues that felt more like distribution, with the market trading broadly between 10,000 and 11,800 before eventually having a markdown towards 10,000.
Right.
Late 2019, post-election rally looked like accumulation transitioning back into participation, pushing towards 12,400.
Yeah,
And then, well, COVID hit.
March 2020, a massive rapid markdown.
Exactly. Down to 7,511. But the recovery from that low through late 2020 and 2021, that was an incredibly strong participation phase. Global stimulus, vaccine hopes, huge retail FOMO. Nifty went all the way to 18,600.
An incredible run.
Followed by, again, signs of distribution in late 2021 and early 2022. Geopolitics, rising interest rates globally. The market churned between 17,000 and 18,600 before another markdown phase took it down towards 15,200.
Okay.
And then from mid-late 2022 through 2024, we saw what looked like accumulation building a base around those lower levels, followed by a transition into the strong participation phase that took us up to the recent highs, fueled by good earnings, FIIs returning, positive U.S.-India vibes.
So the market definitely moves in these broad waves, influenced by all sorts of factors. Now, let's zero in on the very recent past. From that peak in September 2024 up to right now, mid-May 2025, what's the Nifty telling us? What phase are we in now?
Okay, looking closely. We peaked around 26,277 back in September 2024. Then we saw a correction, didn't we? A pullback.
Right, came down quite a bit.
Yeah, it dipped down towards roughly 21,750 by March 2025. The low near 21,800 in March, especially with the RSI indicator showing oversold conditions, suggested selling pressure was exhausted. Maybe some accumulation was happening there.
Okay, a potential bottom. What happened next?
Since then, we've had a pretty strong rebound, a decisive break back above the big psychological level of 25,000. As of today, May 16th, 2025, we're hovering around 25,019.
A significant recovery. What's driving it?
Seems to be a mix of things. We've seen FIIs coming back in, buying significantly over 5,000 crore recently mentioned. Corporate earnings season has been pretty decent for many Nifty companies, and global markets have been generally supportive. Technically, some chart watchers point to a potential triple bottom pattern forming around the 24,500, 24,700 area before the breakout above 24,800, which is seen as bullish.
Wait, so putting all that together, the rebound, the breakout, FII buying, earnings, technicals, where does that place the Nifty in our cycle framework right now?
Based on all that evidence, the most likely assessment is that the Nifty 50 is currently in the early participation or markup phase as of mid-May 2025.
Early participation. What makes you say that specifically?
Well, several things line up. The clear breakout above 25,000 reaching a 7-month high. The pattern of higher highs and lows starting to form again. That's significant volume on the initial breakout days. The return of FII buying. Plus, you look at sentiment retail traders on X seem quite optimistic again, talking about a multi-month bull run. Add in the decent earnings, government spending focus, positive global cues. Technically, momentum indicators like the Mansi D have turned bullish, and the market's PE ratio seems stable in the low 20s. It all points towards the start of a potential new upleg.
Okay, early participation sounds promising for the bulls. But you probably have some caveats, right? It's never that simple.
Absolutely. Always need to consider the risks. One flag is the RSI is getting close to overbought levels again, around 70. That suggests the market might be due for a pause or a pullback soon.
Running a bit hot.
Could be. Also, while volume was strong on the breakout, it has tapered off a little in the last few days. We'd want to see volume stay strong to confirm conviction. If Nifty struggles to hold above 25,000, we could easily just consolidate sideways for a bit, maybe between 24,500 and 25,500.
Yes.
Sector rotation is something to watch. Financials have been leading this rally strongly, but ideally for a healthy participation phase, you want to see other major sectors like IT, autos, metals, pharma joining in more convincingly. They've been lagging a bit.
Broader participation is better.
Exactly. And finally, there are technical resistance levels ahead, maybe around 25,300 and then closer to 25,500. If the market stalls hard at those levels, especially with negative divergences or weakening volume, that could signal this rally is running out of steam and we might actually be entering distribution instead.
Okay, so the base case is early participation, but we need to be watchful for signs of stalling, lack of broad participation, or failure at resistance, which could hint at distribution setting in. Given this nuanced picture, what does it mean for different types of investors right now? Let's start with the long-term folks, SIT investors.
For long-term investors, people doing regular SIPs and nifty ETFs or good diversified funds like, say, Parag, Purik FlexiCap, the general advice is usually stick to the plan. Don't try to time the market too much.
Keep investing systematically.
Right. The long-term trend for India is still seen as positive by many. You see targets like 27,000 or even higher on X for 2026. If there are dips, say back towards 24,500, that could be an opportunity to add modestly as the valuation becomes a bit more attractive. Focus on quality large caps, the Reliances, HDFC banks, TCSs of the index. Keep that 3 to 5 year view. If you did invest a lump sum recently, maybe consider a stop loss around 24,200 just for risk management.
Okay, stay disciplined, use dips. What about shorter-term swing traders looking at maybe 1-3 months?
For swing traders, it's a bit trickier now. The easy part of the bounce might be done. Buying pullbacks towards support, like that 24,740 or 24,570 area, might make sense, targeting resistance near 25,300 or 25,500.
But avoid chasing it up here.
Probably wise, yeah, given the near overbought RSI. Maybe look for opportunities within that potential 24,500 to 25,500 range if it consolidates, or focus on specific stocks showing relative strength, perhaps something in defense like Bharat Electronics or financials like ICICI Bank if they continue leading. Strict stop loss below support like 24,500 is crucial, and maybe take profits in stages, say every 30, 50 nifty points on the way up.
Got it. Manage risk, look for specific opportunities, and for the very short term, the intraday traders.
Intraday is always about immediate momentum. Look for confirmed breaks. Say a solid 15-minute candle close above 25,050 might offer a quick long trade, targeting the next small resistance, or a break below 24,900 might offer a short.
Avoid the choppy middle ground.
Definitely avoid tight directionless ranges. Focus on the high volume movers like Reliance, HDFC Bank, where there's usually enough volatility. And the rules are even stricter. Very tight stop losses, maybe 20, 30 points, and take profits quickly, maybe 30 points or at the first sign of stalling. Don't overstay your welcome.
Makes sense. Any final general tips for everyone watching the market now?
Yeah, a few things. One, keep watching sector performance. Our IT, autos, metals starting to pick up. That would strengthen the case for broader participation. Two, track the FIDE Flows Daily Money Control NSC website. Have this data. Big institutional buying adds conviction. Three, keep using your technical tools, TradingView, Kite, whatever. Mark those support resistance levels. Watch the RSI and Mansi for confirmation or divergence. And four, just stay cautious and flexible. If Nifty fails to break that 25,300 area or worse, falls back below 24,500, be ready to accept that the phase might be shifting towards distribution or correction. Watch for bearish patterns, watch for volume drying up on rallies, don't get locked into one view.
Excellent points. This has been a really illuminating deep dive into market cycles, especially grounding it in the Indian context and the Nifty's recent action. It really hammers home how useful this framework can be for making more sense of the market's movements.
Absolutely. It's not perfect, no system is, but understanding accumulation, participation, and distribution gives you a valuable lens to view market behavior and potentially improve your decision-making and risk management.
So, recapping the Nifty 50 as of mid-May 2025, the evidence leans towards an early participation phase, suggesting potential for more upside, but definitely with some warning signs and resistance levels ahead that could signal a shift towards distribution if momentum fades. Need to stay watchful.
That's a good summary. It's dynamic, things can change, so ongoing observation is absolutely key.
Which leads us perfectly into our final thought for you, our listener. We know markets are interconnected, and domestic policies or global events can change things fast. So, thinking about the Nifty's current early participation phase, what specific global event or unexpected domestic policy shift do you think could be a catalyst to suddenly knock it off course? What potential disruptors should you be keeping on your radar that might signal a faster than expected end to this phase or a shift in the cycle? Something to definitely ponder as you do your own research and watch the markets unfold.
Indeed. Thinking about those potential catalysts, both positive and negative, and how they might impact sentiment and flows, that's a crucial part of staying prepared in today's market environment.